The Icons of Real Estate Podcast. Are you ready to learn the proven money-making secrets from top-producing Icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week with your host, Tomasz Fonseca, and find out how to implement proven strategies to 10 times your business. From $3 million to $30 million in just 12 months. Brought to you by the Masters at Real Estate Marketing, Arter SEO.
Welcome to the Icons of Real Estate. I'm Tim Calloway. We have a very special guest with us today, Jonathan New, Director with Fair Winds Capital Investments, a real estate syndicate managing over $64 million in assets. Fun fact, prior to moving into real estate investments, Jonathan served in the U.S. Navy for 16 years. Jonathan, welcome to the show and thank you for your service. How are you?
I am fantastic. How are you, Tim?
I'm doing well. So let's start from the beginning. Before you got into real estate, the Navy.
Okay. Well, I'm still in the Navy, actually.
Okay.
So I am my last job. I'm the executive officer, second in command of the University of Florida's Navy ROTC.
Oh, wow.
Yeah. Fun fact, I live in St. Augustine, Florida, but I travel that 75 miles one way to work every single day.
Wow.
It is my last job, and I figured it'd be a great opportunity to keep my three little ones in the same school.
Sure.
Some continuity for the first time in their lives.
Right.
So we're excited about where we're at right now.
That's fantastic. Well, I'm just south of you. I'm down in Boynton Beach. So
Oh, nice.
yeah, we're almost neighbors, 5
Yeah,
hours.
right there. 5 hours. Right there, same state.
Yeah. So tell me, how did you tell me the backstory of college, military, and then boom, hey, real estate.
Yeah, absolutely. So I grew up in a little town called Anniston, Alabama. And from there, I went to Auburn University. I started off in engineering, went to another engineering major, and then I basically said, this is for the birds. Let's go psychology. So then I graduated with a psychology degree and got into the Navy that way. And so we went to like Mississippi and then Florida, got my house and everything got destroyed in Katrina.
Right.
It happens.
Yeah.
But then my wife and I bought our first little house up here in Jacksonville, back in 2007, which was a terrible time to buy a house in Jacksonville. So then we got
I didn't.
Yeah, exactly.
I don't know if there's ever a bad time to buy a house in Jacksonville. I won't say all of Florida, but Jacksonville's a nice place. So
it is a very nice place. But we bought the thing for $199,000 in 2007. I got orders to Japan and we wanted to sell it, and it was worth $99,000 when we had to leave. So we became landlords. And after a few years of that and seeing the values start to come up a little bit and the cash flow started to come in, and it clicked in my head that these tenants of mine are paying off a $250,000 house, and I'm getting it was $50 worth of cash flow at the time. But it clicked in my head that I could get 4 of these things and have $1 million worth of retirement income. And it was an amazing thought to me. But then I got into bigger pockets and figured out that there's the BRRRR strategy and there's no limit on how many houses you could get. Right. So I went crazy just buying up and rehabbing houses, and I was doing 5 every single month. And it got to the point where I was just tired. I was really tired of doing everything by myself. And so then I discovered the syndication world. I started raising money from a lot of people to do all those single family houses. And I thought, let's just scale this thing up and do multifamily, large multifamily. And then I met my wonderful partners, Corey, Vadim, and Jasprit. And we clicked on every single level of business and personalities. And they had have a lot of similar interests for business. So we formed Fair Winds. I still have 2 years left in the Navy. Corey recently retired from naval service Vadim just got out, and then
Huh?
Jaspreet was a merchant marine. So we've got that. We've got a very diverse and strong background within the military. I mean, everything about our company is is rooted from the military. Fair winds comes from a term called fair winds and following seas, which is what you say to another service member in the Navy when they
Mm-hmm.
leave your command. We have our property management company is called Following Seas. Our newspaper is called Scuttlebutt. So it's we
Right.
do everything stems from our service
From our
background.
background, yeah. That's fantastic. So, I come from a REIT background, and
Nice.
I'm
Yeah.
gonna predate you pretty far back, but going back to like 1992, with Bear Stearns. I don't know if you're familiar with who they were, but
Hmm.
packaging those and retail marketing them out. So, but talk to me like I'm a novice. To explain to me what syndicate management is and how it works. So, maybe that person today listening or tomorrow or next week says, yeah, that's what I need. I just didn't know that's what it meant. I've heard it. What does that mean and what's the definition?
So when I syndicate one of these big deals, take our most recent, it's a 208 unit in San Antonio that we're closing on here in a couple of days. So
Hmm.
what I'm doing is I have to raise $6.3 million dollars. So what I do is I go out and I bring a whole bunch of people's money together that are interested in in owning the real estate, but they don't want to do any kind of like asset management or day-to-day
Right.
management for the asset itself. So I do that for them. I go out and find the deal, negotiate the deal down to make sure that it's a good investment financially. And then I do all the due diligence on the property. I go out and get the right sized loan for it that's as safe, as mitigated as I can get it.
Right.
And then I go out and I find the equity for it. We put our own equity into the deal, but then we bring in the rest of it. In this case, it'd be like 500 or $5.8 million dollars that we have to go find from other people. So we go out and we bring in friends, family, and accredited investors that we get from our marketing strategies. And we have to go through our SEC attorney
Hmm.
since we are giving out securities
Sure.
towards limited partners who don't have an actual job within within the management of the property itself. So we go out and we can get a security offering, which is a 506, and then there's a couple different avenues from there that you can go in. There's actually several different, but I'm going to talk about specifically the 506C, which allows me to market to the world. I can tell everybody about my deal, but I can only bring in accredited investors. And in this case, that's if you have an income of $200,000 or $300,000 with your spouse, or have a net worth of $1 million, not including a personal home. And then there's a whole bunch of brand new professional qualifications that the SEC just came out with about a year ago that allows you to be an accredited investor. But I can also do a 506B, which just means that I have to go out to only the people that I have a relationship with. And then I can only bring in a couple dozen unaccredited investors, and then I can fill out the rest with accredited. So with this being like a $6 million deal, $6 million equity raise, it's much easier to just be able to market it and then bring in accredited investors.
Got you.
So
Okay.
that's basically what a syndication does.
Perfect. Perfect explanation. So now let's take it a step further. Let's say I am an accredited investor. Now, I've worked with accredited investors in the past, and I can say this with honesty and understand that though they're titled accredited investor, doesn't necessarily mean they understand everything that they're investing in. And so my question to you is if I'm an accredited investor, let's just say I've built my wealth somewhere else, and I say it's just time, I do this. What's the expectation that you set, and what is the expectation they generally have when they step in?
Now, I need to clarify what you're asking here as far as
Okay, so just the expectation. I mean, when you bring in an accredited investor in, what is the expectation you set for them as an investment?
So when I bring in an investment to them, I'm going to okay, so we want to bring in an asset that has really good bones. We
Mhm.
want to bring in an asset that has some level, so I do multifamily value add. Some other guys do multifamily
Right,
core, like brand new stuff, really sexy class A type stuff
right,
that just cash flows a little bit, but not a huge value add piece. So what I look for is some level of distress so that I can force appreciate and get that asset to bring my accredited or any of my investors, period,
right.
some level of immediate cash flow. Usually for a value add, it's going to be small in the first year, maybe 2 years, depending on the size of the project that it has the business plan that has to go to make the asset perform. And then ultimately, I'm trying to get into the high teens for an IRR, internal rate of return, which
Right.
is basically just a fancy way to say your investment gets like 17%, and then
Mhm.
it takes into account how many years or how long your capital is actually held by the property. It's very similar to average annual return.
Okay.
Uh, it's just a little bit more nuanced.
Yeah.
So I'm trying to get into the high teens, cash flowing year one, and then I want to exit the property between years 3 and 7, depending on the value add, or depending on the business plan, really.
Okay.
And then my expectation for the investor is that they excitement with questions and make sure that they know what they're getting into. And my team, we really pour as much time into each investor as they really need to make sure that they're comfortable and ultimately excited about the project.
Fantastic. Good answer. I liked it. Uh, Next question. I looked over your portfolio a little bit, and I did
Mhm.
notice. I talked to a lot of managers, and sometimes, or a generality, is they work in a certain area. I saw that many of your properties are all over the place, or in different areas of the country. Tell me your process about finding them. Tell me your process about negotiating for them at a distance.
Oh, fantastic. So, I mean, with the advent of the internet, we can be anywhere and everywhere as far as like
Right.
being able to see things and to talk to people. So it's great to be able to connect with people. But at the same time, so I live in Jacksonville, Florida, but we own assets in San Antonio and
Right.
Houston, whereas the rest of my team lives in San Francisco and in Hampton Roads area, Virginia.
Right.
So it really means that you need to have some level of familiarity with what's going on with a project. We go out and we lay eyes on everything that we get under LOI before we ever sign the PSA. And in the case of San Antonio, it was our first. Okay, I'll back up. So when we got into Houston, we had a partner that had experience in Houston, and that's what got our foot into the door. And once we had the experience, then we can go out and buy other properties in Houston. And so we have Houston experience. With San Antonio, what we did is we went and we have our third party property management company already has 5,000 units in San Antonio under their property management. And also, one of our partners is actually moving on site to monitor the business plan. As far as negotiation goes, everybody says they try to be conservative. Of course they do. What does that really mean?
Right.
Well, that's something you got to be very, very careful about. We maintain a very robust data room for our due diligence that we share with everyone that's even thinking about investing. It's got our underwriting, all the due diligence, all of the contracts that are going into what's going to be happening with the property management, the contracting services, vendors, everything that we have is in there that everybody can see to try to be as transparent as we can possibly
Sure.
be. And then it boils down to having some sense of an ability to underwrite and your trust in that syndicator, that sponsor.
Gotcha. Okay.
Negotiation is deal by deal.
Yeah,
You know,
deal by deal, right? And group by group, I'm sure.
you got to be
Yeah.
able to read people and see
Right.
what's most important to them. Some people they want hard EMD on day one. I'm
Right.
not doing that anymore.
You get your poker face on, Jonathan.
Yeah, absolutely.
Okay, so I was, looking at the numbers and everything, and I see that assets under management run about 64 million. That's still
Mhm.
par, still correct.
Yep,
So
that's correct. We should break the 100 million mark by the end of the year. We'll break 880 units, we're hoping. So we're closing the San Antonio deal in the end of September, and then we've also got a 220 unit hotel conversion in Houston that we're taking on. And I'm hoping that when we get done with this podcast, I'll open up my email and see an accepted LOI on another Houston deal.
oh, fantastic. That's my hometown, so more luck to you there.
Nice. Love Houston. Houston's so fun. It's treated us so well. We love
Yeah,
it.
it's a good city. I haven't lived there in some time, but I did spend a large part of my life there and Dallas.
Mhm.
But so I'll go ahead and I have another question for you, but I'll start with this one. Um, just in the past week, I've talked to a lot of syndicate managers, and Texas seems to be, um, I hate using the term a hotspot, but it's, you know, s- buildings still having bones on them, not so much inflated pricing. Is that your take on it, or, is the rest of America just far and away from your parameters only?
Oh man. Well, a year and a half ago, I did not want to get into Texas because I didn't want to jump into the hot spot, like you said. And it
Yes.
it, it really is. I thought that Texas was going to be overinflated. Everybody's trying to get into Texas. There's just there's a lot of deals that are flowing in out of Texas right now that everybody can get their hands on. And as such, the pricing hasn't skyrocketed to the point
Right.
that doesn't make any sense. It was getting kind of crazy about a year ago but I think this was more nationwide. Everybody was pricing their projects off of pro forma. It's going to be worth this, so pay me
Right.
this. Yeah,
Right.
it got stupid.
Yeah. It always does.
Absolutely insane. Absolutely insane. Like I can't get a deal here in Jacksonville. I've been looking since I moved here. It's
Yeah.
just impossible.
Good luck. I
Yes,
can't.
sir.
I'm in Southeast Florida, and not to, I have a son that's buying a house in Orlando right now. Giving my
Woo!
age a little bit. Yeah, and I'm like, he comes to for advice, and I go, advice? Yeah, don't pay that much. But
I
what,
won't get it.
what are you gonna do, right? I mean, they're like, but we want to buy a house, Dad, and they make the money to do it, and they can do it. But I just, in my gut, in my logical senses, I go, I was just here. I live 2 hours away, and I saw this house for, 200,000 less, 2 years ago, and it's a difficult task, and so you better love it, and I won't get into that. I won't jump on that soapbox, but
Hmm. No,
so so
I'm with you.
yeah. So I'm gonna go back to what I was talking about before,
Yeah.
about assets under management. Okay, so you listed some deals. Hopefully that mailbox opens here, after this call, and you get what you're wishing for. Got a couple other deals you're working on. So what's the big picture goal? And when I say big picture goal, let's you and I time travel 5 years into the future.
Yeah.
Where do you see yourself, and where do you see, Fairwinds? How are you going to get there?
So what we want to do is we want this to be our core, this value add multifamily. We want to continue to build out our investor database, but we also want to get into the spot where we're just doing JVs with people, like having just one equity partner come in and
Right.
provide like 90% of the equity. It's very difficult to find. You have to develop the relationship with those types of people. And we want to start getting into different asset classes other
Hmm.
than just the multifamily value add. We want to get into like hospitality.
Oh, sure.
Maybe it just depends really. Maybe some develop. We do love development. We just don't have the experience in it yet, and we're trying to focus on our core strength at the moment. So in 5 years, I want to diversify and then start developing equity and debt funds for investors to come in that way.
Yeah. Okay. So one last question I ask. every syndicate manager or every investment company the same question. And it's only because I've gone through it recently and my 4 sons will eventually go through it. So there's a big transference of wealth,
Mhm.
kind of cycling right now.
Yeah.
Boomers being the ages they are. My parents are in their mid 70s and so on and so forth. I'm in 52, and I have kids in my
Sure.
20s. So, you look at these generations and money's kind of being passed, right? So it's kind of going back to the accredited investor situation. Let's say I'm not an accredited investor, but I've been passed down a sum. What is your advice for those people? And I'm not really talking people my age or with my knowledge. Let's say the 20 something, 30 something millennials that are now getting into that age and phase where they have real money or they're being passed on several $100,000 to $1 million. Can they come to you? Do they not qualify for any of the programs that you offer?
No, we try to make sure that we have a 506B continually
Continuing.
going on so that we
Great.
can we do have those kinds of options out for our people. I mean, I'm developing like an equity sharing fund that would
Okay.
just basically share in it's also a 506B because I've still got a lot of friends and family that aren't accredited, and
Right.
they're always asking me about opportunities. So we want to make sure that we stick to our roots.
Right. You don't want to do
None of us
this,
are born accredited.
right.
None,
I can't talk to you. Sorry.
yeah, no, absolutely. And then you get into like the 506Cs where the minimum is like 50 grand, and then
Right.
I mean ours is all 50 grand for a minimum. It just has to be that way so you
Right.
can limit the number of investors that you have to deal with. Investor relations can really bog down a company's rhythm if you're
For
having
sure.
to talk to different people all the time.
Yeah. I mean, you definitely have to keep it in alignment of some sort. So,
100%.
well, good
Absolutely.
stuff. I always give everybody the opportunity to have the last word. If there was anything we didn't cover or anything you had to say, have at it. And how can folks get in touch with you if they are interested in investing with you, or maybe just want to get your advice?
Yeah. So I would encourage people to go to our website. It's www.fwcinvestments.com. Obviously, I want to partner with anybody for buying up real estate, but at the same time, I just want to talk to people. Please come reach out to me. I love talking to people. I'm actually naturally an introvert, but I do
I don't
once I
believe
get
you.
to talking once I get to talking to people, it's a lot of fun. So I want people to come talk to me, get educated, and get introduced into real estate. I also got some cool sea stories we can talk about too. So please
Like,
reach out to me. I'm also Jonathan at fwcinvestments.com.
okay. Well, I'd love to hear some of those stories for sure. So I definitely look forward to that day and time. Jonathan, thanks for being on the show. We really enjoyed it. Once again, thank you for your continued service, and you have a wonderful day.
Tim, thank you very much. Very professional webcast.
Thank you.